Good evening. Thank you for joining me. My name is Brandon Moncrief. I'm going to be your host tonight. And tonight we're going to be discussing the 5 pillars of a successful DSO transaction. But we'll be talking about a lot more than that. We'll be covering current market conditions, DSO deal structures, DSO myths, and what can go right and go wrong in a DSO transaction. So I appreciate you spending the next hour and a half with me, and hopefully you get a lot out of this webinar. So with that, we'll hop right in. So as I said, my name is Brandon Moncrief. I'm the principal and CEO of McLaren & Associates. To tell you a little bit about my background, I've got 22 years of experience in the dental industry. I spent about a decade as a banker, lending money to dentists all across the country to buy practices. And in that role, I really saw everything that could go right and go wrong in a doctor-to-doctor transaction. I've been involved in about 1,500 practice transitions all across the country. And for the past 5 years, I've really dedicated my career to doing sell-side advisory for large practice owners and emerging DSOs who are looking at affiliating with the DSO or bringing on a private equity partner. I couldn't do what I do every day without our awesome team. So that's these good looking people right down here. We've got a diverse group of people, but all of them have deep roots in the dental industry or banking and finance. So we've got several former bankers like myself on the team. We've got a former investment banker, Wharton MBA, law degree from Penn, former Patterson rep, as well as a former dentist on the team. So we've got a fantastic team. And they serve our clients nationwide. We've actually got offices in Atlanta, San Diego, and our headquarters here in Austin, which is where I'm broadcasting from tonight. So let's talk a little bit about our company. We've been established for 35 years, been involved in over 1,000 successful practice sales. That's doctor-to-doctor transactions, as well as DSO and private equity transactions. We've closed $1.2 billion in transaction volume, with that number growing every day. We specialize in providing sell-side advisory for DSO transactions. So helping large practice owners, multi-site practice owners, multi-million-dollar revenue practice owners plan for an eventual exit, a sale to a DSO or private equity. We're headquartered in Austin, but we serve clients nationwide. A lot of people ask me, where did the name McLaren come from? My last name is Moncrief. McLaren was originally started by Paul McLaren, who was a practicing dentist for about 15 years in San Antonio, had a disability and had to reinvent himself in dentistry, and started McLaren & Associates back in 1987. Paul was an amazing mentor to me, and we bear his name to honor his legacy. Throughout the night, if you have questions, I encourage you to ask them. I'd love for this to be as interactive as possible. So you'll see at the bottom of some of the slides, there'll be instructions on how to ask a question. You can either text me or you can type a message in the right-hand corner of your screen and hit send. I'll see it, and then I'll bring it up as we go through the presentation. So if you see me looking at my phone tonight, I'm not checking Facebook or Instagram. I am looking at your questions and look forward to answering them. So before we dive in and get real technical talking through DSO deal structures and what can go right and wrong in one of these transactions, let's talk a little bit about DSO private equity terminology. So private equity. Private equity essentially means a firm that's typically run by business people and finance and banking people that manage money for high net worth individuals. So private equity is tasked with taking money from investors, buying a company, building a company, and then monetizing and exiting that company and returning the cash to the investors with a handsome return on top. So that's essentially what private equity is. Most of the DSOs are backed by private equity or a family office. A family office simply means it's essentially a private equity firm that manages the money for one or several high net worth families. EBITDA, this is a huge talking point right now in dentistry and the DSO world. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Think about EBITDA as absentee profit. So if a private equity firm or DSO bought your practice after all the overhead is paid, including paying a doctor to do the dentistry, how much money is left over? So revenue minus real overhead minus doctor compensation essentially equals EBITDA or absentee profit. Recapitalization event. So private equity has a goal of building a business and exiting it and liquidating that asset, typically within a 3 to 5 year window. When they exit, so when the private equity firm that currently owns the DSO sells that DSO to the next investor in part or in full, that's known as recapitalization event. And at a recap event, the private equity firm, as well as typically the management team of the DSO and the doctor partners, have an opportunity to liquidate all or at least 50% of the equity that they own in the business. So recap events are typically happy days if it's accomplished at an attractive multiple and generates a significant return for the investors and the dentist alike. Arbitrage simply refers to the gain between what was invested in the DSO and what it ultimately sold for. So when we talk about arbitrage, that's essentially the return that private equity is generating for the investors involved in the DSO. Equity versus leverage. Equity is actual investor cash as well as cash or practice value from the doctor partners that is invested in the platform. Leverage is cash, but in the form of borrowed funds, typically from banks. So think of equity as cash from investors and leverage as borrowed funds from banks. The next two terms describe the type of equity that is going to be involved in a DSO transaction. And there's either joint venture equity or holding company equity. Joint venture equity refers to retained equity within your own four walls. So we'll talk about joint venture deal structures in a little bit, but in that scenario, you sell typically a majority ownership interest in your practice, and then you retain equity actually at the practice level. That's joint venture equity. Holding company equity is when you're going to sell, let's say, 100% of your practice and take 20 to 30% of the value, the cash that you would receive from the sale of the practice, and you're going to invest that in equity stock in the parent company of the DSO. That's referred to as holding company equity. So as we get into talking about deal structures tonight, we'll talk a lot about joint venture equity versus holding company equity and what the pluses and minuses of each of those types of equity are. So it's good to know, what is the private equity playbook? How does private equity approach not only the dental industry, but really every industry in which they invest? And the consolidation that's happening in the dental industry today is not unique to dental. It's been happening in other verticals for quite some time. There was huge amount of private equity investment in tech in the 2000s and teens. A lot of the tech money has now moved to healthcare, and dentistry being one of the strongest performers from a healthcare perspective has got the interest of private equity. So how does private equity typically work? They're going to go out and they're going to raise a fund from investors, and that could be anywhere from $20 million to $50 million typically. They're going to acquire what they call a platform. So they're going to buy typically a multi-site practice with annual revenue, let's say of 10 million plus, and EBITDA of 2 to 3 million plus. So they want to make a splash. Let's put it that way. They want to have a significant platform that's got likely some centralized infrastructure, a business that's scalable, so that once they buy that platform, they can immediately start to add practices in the surrounding geography. That may come through acquiring other practices, starting practices, or both. And once they get to a point where they've got 5 to 10 offices, they're going to build infrastructure. So they're going to build an accounting department. They're going to hire attorneys. They're going to handle compliance. They're likely going to have an HR component, doctor recruiting, staff recruiting, payroll, revenue cycle management, marketing. They're going to build robust infrastructure to support the practices that are currently under the umbrella, as well as those practices that they're going to continue to acquire and start from scratch. They're going to leverage economies of scale to increase revenue and decrease overhead. Because of their size, they can negotiate more favorable reimbursement rates from payers and more favorable pricing from vendors. So DSOs typically buy supplies and equipment for 40% less than what private practices do. So the DSOs of today are in the business of partnering with, acquiring quality practices, and then making small, very, very small changes behind the veil, leveraging economies of scale to increase revenue, decrease overhead, and drive up EBITDA without disrupting the autonomy of the doctor, the team, and the patient experience. After they've run this playbook for 3 to 5 years, after they've built up to a point where they've got 30, 40, 50, maybe 150 practices, they've built infrastructure. They're sitting at 30 to 50 million in EBITDA. They're going to look to recapitalize. They're going to look to sell that investment to the next private equity firm or family office that is then going to repeat the cycle. They may pay 12 to 15 times EBITDA to acquire that DSO. And the goal is then to continue to build that DSO, acquire EBITDA, start practices, leverage economies of scale, cost average that investment down. Let's say they pay 12 times EBITDA to buy a DSO. They're going to go out and they're going to acquire practices for 6, 7, 8 times EBITDA, bring that cost average down, double to triple in size, and then sell it to the next investor. So that's how private equity essentially works in every industry in which they invest. So let's talk about what's going on in our industry. What's happening with dental industry consolidation? So capitalism is generally set up so that the rich get richer. And as the rich have gotten richer, as the stock market has continued to grow, investors, high net worth individuals, need to diversify their portfolio. So they're going to have equities, they're going to have bonds, and they're also going to have what we call alternative investments. And that's where private equity comes into play. So you've got high net worth individuals that have a ton of cash and are looking for a place to invest it that has a little bit higher risk than maybe bonds or equities, but has the potential to return very high returns. And that's what private equity does. They leverage investor money with bank debt and invest in stable, highly profitable, and fragmented industries that can benefit from organization and from centralizing administrative services and leveraging economies of scale and creating arbitrage, creating a return. So the dental industry fits the investment thesis of private equity firms essentially perfectly. So that's why we've seen so much interest in the dental industry leading up to COVID, and especially coming out of COVID, when dentistry proved once again that it's recession proof and, didn't know this, pandemic proof. But it makes sense. I mean, dentistry, because you're operating in people's mouths and in close proximity to their face all day, was way ahead of other medical verticals in regards to PPP and protecting yourselves from airborne illness. So it only makes sense that dentistry was kind of ahead of the curve in regards to dealing with the pandemic and rebounded very, very quickly. But let's talk about why DSO is really no longer a 4-letter word from a doctor perspective. And some of you may be watching this webinar and saying, hey, it's still a 4-letter word to me. I'm not here to change your mind in that regard. We built our business for 30 years focused on doctor-to-doctor transactions, keeping private practice private. But 5 years ago, when we noticed private equity coming in the dental industry, doctors weren't educated about EBITDA, how PE invest in businesses, how they view deal structure, how they view valuations. And that meant that our industry was ripe for doctors getting taken advantage of. And that's why we got involved. So we're not necessarily a proponent one way or the other to sell your practice to another dentist or sell your practice to a DSO. Our job is to arm you with the information that you need, empower you to make good decisions for your practice, whether a DSO affiliation makes sense or not. So why do I believe that dentists, in large part, no longer look at DSO as a four-letter word? One of the big things is they've learned to stay in their lane. So they've learned to support practices from an administrative perspective and allow for complete clinical autonomy. They stay out of the operatory. So DSO version 1.0 was more kind of the doc in the box. They all shared the same brand. They looked at a front office person and a dentist essentially the same. They're just an employee. Private equity DSOs are smarter than the doctors, and they're going to tell you what to do. That was DSO version 1.0. Guess what? It didn't go well because the business people are not smarter than the clinicians. DSOs today have learned to partner with doctors. They no longer look at doctors as simply being employees. They refer to them as partners. And that's whether they buy a portion of your practice or 100% of your practice. So I really feel that they learn to stay in their lane. They partner with great doctors and great practices, leverage economies of scale behind the veil, do everything they can to just continue the success that business has already enjoyed and not screw it up. They're not trying to reinvent the wheel. They're not trying to do what DSO version 1.0 did. They've allowed doctors to participate in the financial arbitrage that private equity investors are enjoying. DSO version 1.0, they owned 100% of the practice. They reaped 100% of the reward. In today's marketplace, in your deal structure, you're highly likely going to have some type of equity component, whether that be joint venture equity or holding company equity. And you're going to have the opportunity to liquidate that equity in part or in full, hopefully at a handsome return at a recapitalization event. That's relatively new. DSOs understand that they want their doctors to be treated as partners and have skin in the game so that everybody's swimming the same direction. If private equity wins, the doctor wins. If the doctor wins, private equity wins. It's a win-win situation. And that's why sharing in that financial upside, I believe, has made doctors a lot more willing to entertain the thought of affiliating with the DSO or partnering with private equity. Here's a big one: significantly higher practice valuations. So historically speaking, from a doctor-doctor perspective, you would look at selling your practice for somewhere in the range of 70 to, at the top end, around 100% of annual revenue. DSOs, private equity, they don't really care about revenue. They care about profit. And if your practice is engineered in a way that it's got the size and the profit, the EBITDA, to attract private equity, to attract a DSO, we'll talk about what DSOs are looking for in a minute, your practice could sell for 150% of revenue, 200% of revenue. We've sold practices for as high as 350% of revenue. So comparative to selling to a private buyer, it's hard to ignore those economics. It's a compelling argument that if you have a large practice, to at least explore what it would be worth in the DSO private equity world comparative to the private buyer world. And that's often what we're engaged to do. We'll talk about our process in a little bit, but we always start with doing an EBITDA analysis and doing a valuation. What we often do is we do a valuation from both a doctor-to-doctor perspective, a private sale perspective, and a DSO perspective, and arm you with the information that you need to quantify what that delta looks like and see if the economics of pursuing a DSO affiliation are attractive enough to compel you to go down that path. But it's not all about economics. And that's when we get into the 5 pillars of a successful DSO transaction. We're going to talk a lot about the other things outside of simply valuation that matter in these deals. Over the past 10 years, the burden of management has increased substantially. So you've got to be a more sophisticated business owner to be a successful dental practice owner in today's environment. Competition's at an all-time high. As we all know, overhead only goes up over time. It really never goes down. You're having to deal with PPO infiltration and downward pressure on pricing. And then, as you all know, likely your biggest pain point today is staffing, HR. The labor market has been an absolute mess coming out of COVID. And we don't really, see that changing anytime soon. So because DSOs in private equity are run by business people and they're designed to support practices from a business and administrative perspective, along with the fact that we've got an increasing management burden, it's caused a lot of successful practice owners that manage a big team. And, they've gotten to a point where in some ways the business is running them rather than them running the business. They've looked at DSOs and private equity as a way to offload some of that management burden and get back a little bit more of their quality of life, spending time on things that they enjoy, not spending time on things that they weren't trained to do and that keep them up at night. Just a reminder, if you've got a question, please type it in the bottom right-hand corner and hit send, or send me a text message to my cell phone and I'll be sure to cover it. So let's talk about current market conditions. Practice valuations have increased substantially post-COVID. So going into COVID, there were 150, 200 DSOs operating nationally. A lot of demand from DSOs. Valuations were at an all-time high. We hit about a 6-month period of time where most DSOs were not buying practices or pulled back substantially from a valuation standpoint, waiting to see how COVID was going to play out and how it was going to impact the industry. Dental already had private equity's eye. It was already a highly coveted industry. Some would argue going into COVID, the hottest vertical in private equity. And then once dentistry rebounded faster than any other medical business, possibly faster than any business in general coming out of COVID, it reaffirmed private equity's viewpoint on dentistry as a very investable business. So as a result, we've currently got over 300 DSOs operating nationwide, and demand is really at an all-time high, despite the fact that we've got rising interest rates and recessionary fears have caused banks to tighten up. So I think the biggest headwind that the DSO industry currently faces is the regional banking crisis that was caused by SVB defaulting, as well as a couple of other regional banks. Those are the banks that fund private equity and VC investors. So banks have tightened up recently, and they're not extending as much leverage to private equity-backed DSOs. As a result, some DSOs don't have the capital to bridge the gap between market value, what they have to pay for a practice, versus what a bank will lend. For example, a lot of practices right now are trading for 7 to 8 times EBITDA. Over the past few years, banks have been lending money to DSOs at as high as 6 to 7 times EBITDA. So private equity was having to inject very little cash into these transactions in order to close them. Now, banks have tightened up because of recessionary fears and because of the regional banking crisis, and they're extending leverage at 4 to 5 times EBITDA. So private equity is having to pony up more cash in order to close these transactions. There are some DSOs out there that are not well capitalized. Private equity raised a fund, they've burned through that fund, they no longer have any cash to inject into these transactions, and when the banks pulled back from a leverage perspective, they're stuck. They either have to focus on de novos or organic growth within the practices they own, or they've got to find a new private equity partner. So as a result, we've seen some DSOs look for new private equity partners, in today's environment, it's not really, the timing that you want to be looking for a new partner, and it's caused a little bit of chaos. As a result of current market conditions and economics, several DSOs were eyeing IPOs prior to what we could call a recession that we're currently in. And some recaps, DSOs that are forced to look for new private equity partners are going to be muted to some degree, still generating robust returns. So rather than generating, 50 to 70% IRR, they might generate 20 to 30% IRR for the time being. We're expecting that those storm clouds are going to clear here over the next 6 months, and valuations are going to remain very, very strong. DSOs are going to have a tremendous amount of capital once interest rates, inflation cool off a little bit, and banks begin to relax. So within the next 6 months, we expect that all DSOs will be buying again. The good news is, post-COVID, there's been a lot of new DSOs arise that are flush with cash. They've newly taken on a private equity partner, and they're being ultra aggressive. So while we have some DSOs that are strapped for cash, they're on the sidelines at the moment, we have more buyers in the marketplace than we've ever had due to the rise of the new DSOs that popped up post-COVID. As a result, valuations, when you're talking about practices with EBITDA of 500,000 up to about 3 million, are as high as they've ever been. The only pullback that we've seen a drop in demand for practices with EBITDA of, let's say, less than about 400,000. We've seen a decline in valuations in that lower segment of the marketplace. And we've seen valuations on platform investments, multi-site practices with EBITDA of 5 million plus begin to cool off a little bit. And that's really caused by the lack of access to leverage at high levels. So when we get in the nosebleed section talking about platforms trading for 10 times EBITDA plus, those platforms are going to be under a lot more scrutiny, and that segment of the marketplace is under more pressure. But good news, a lot of our clients are in that 500,000 EBITDA to 3 million EBITDA range. Sky high demand, multiples in the 6 to 8.5 times EBITDA range. So despite the fact that we've got high interest rates, we've got some recessionary fears, we've got some banks pulling back, we've got some DSOs that are on the sidelines not buying practices, we're still accomplishing amazing results for our clients. And we'll go over a handful of case studies here near the end of this webinar. As a result of banks scrutinizing the performance of DSOs and deciding how much or how little money leverage they're going to extend to them, and on the back end when DSOs are looking to recap, those investors are being scrutinized by their banks and therefore scrutinizing the DSOs and their performance more and more. We've seen DSOs begin to focus on same-store sales growth and that's a huge talking point right now, and be more selective regarding the practices that they acquire. So previous to about a year ago, any practice with revenue over $1.5 million was going to be a massive target for DSO buyers. Today, DSOs are being a little bit more selective. If the doctor wants to exit, prior to 3 years, or if the practice has significant Medicaid exposure, if it has any hair on it, the DSOs are shying away or pulling back a little bit on valuation. So if it's rock solid, checks all the boxes, sky high valuations, if it's got some hair on it, it's got a challenging story, a challenging narrative, or some challenging characteristics, where you may have seen 7 to 10 bids previously, you may only see 2 or 3 bids in today's environment. The last thing I'll mention is DSOs are being tested from an operational perspective. So many DSOs have proven that they can aggregate, they can buy practices and integrate them. But now banks and investors on the back end, when they go to recap, they're looking at same-store sales growth. They're asking, great, you can buy practices, you can acquire EBITDA, but do you make the practices that you buy better? How good are you at operating at scale? What infrastructure do you actually have? Is this more of kind of like a duct tape DSO roll up, or is this a true sustainable business that is poised for continued growth once me as the investor acquires it and repeats the cycle that we discussed earlier? So let's talk about why doctors choose to sell to a DSO. I mentioned earlier the difference in economics between a private buyer sale and a DSO sale are typically very compelling. The larger the practice, the more compelling they become. So just for instance, and practices come in all shapes and sizes, but I'm just going to throw out an example. So a practice with 4 million in top line revenue, let's say it has a 25% EBITDA margin. So it's got $1 million in EBITDA. In the private buyer world, one, it's going to be hard to find a buyer for a practice of that size. You're going to have to find a very experienced, competent doctor that has access to bank financing as well as likely some cash. Those are hard to find. Or you're going to have to sell it in pieces to multiple doctors or your associates. And it may trade for 3 million, maybe as high as $3.5 million. Again, 4 million in revenue, million in EBITDA, selling to a private buyer somewhere in the range of $3 to $3.5 million. That practice in the DSO world will likely trade for somewhere in the range of 7 to 8.5 times EBITDA. So 7 million to $8.5 million, more than 2 times what it would trade for in the private buyer world. And while there's a lack of buyers in the private buyer world that are capable of buying a practice that large, you will have DSOs foaming at the mouth. If we send it to 10 DSOs, we're going to get 10 offers. So the demand as well as the valuation from a DSO perspective is leading a lot of doctors to take a hard look at going down that road rather than selling to a private buyer. We've got a lot of doctors that have built very successful businesses, and they've got a lot of their net worth tied up in that business. And they want to take some chips off the table and protect that. Put away a nest egg that they can invest and earn compounding returns. Continue to be a dentist, maybe even continue to own equity in the practice, but just de-risk to some degree. We've got a lot of doctors, especially younger doctors that we work with that are in the age range of 40 to 45 years old. They've owned a practice for 10, 15 years. They've built an amazing business, but it's come at a cost. And that cost has been time with their kids, time with their family, an imbalance in their work-life relationship. And they're looking to improve that work-life balance and alleviate the management burden. They still love being a dentist or love, operations and mentoring and managing, people. But they want to de-risk, take some chips off the table, and they want to get some help from a day-to-day operational perspective. On the opposite end of that, there's also entrepreneurial dentists that have built what we'll call an emerging DSO, maybe 3 to 5 locations. They've reached a point where they want to continue to grow, but they've got to do a couple of things. They may have hit a ceiling with their banking relationship where they can't really borrow any more money from traditional banks. So they need to look to private equity to help continue to fuel that growth. And they've reached an inflection point where they either need to build their own infrastructure and start to centralize services in order to continue to grow, or they need to partner with somebody that's already built the centralized infrastructure, and they can immediately leverage that infrastructure to continue to scale their business. So we've got people on both ends of the spectrum. We've got people that are looking at this as an exit strategy, a way to take chips off the table, to alleviate the management burden and improve work-life balance. On the other end of the spectrum, we've got entrepreneurial dentists that are looking at the DSO private equity option as a route to continue to scale and grow their business. The good news is there are DSOs and private equity firms that are designed to help either party. They may not be the same DSO or private equity firm, but there are plenty of options out there today that can help support your goals regardless of which end of that spectrum you lie on. Dentists would love to take advantage of economies of scale. leverage your payers for better reimbursement rates, leverage your vendors for lower pricing. Because right now, one of the biggest headwinds that private practice is facing is an increase in overhead and a decrease in reimbursements. And that's why we're seeing a lot of practice owners begin to go out of network, dropping PPOs, most notably Delta. We've seen a ton of practice owners drop Delta recently because they'd rather work smarter rather than working harder. And thus far, I don't think I've seen anybody regret moving from being PPO reliant to fee for service and really controlling their own destiny. But it's an issue and it's a risk if you're going to go down that road. And then wealth creation opportunities. So obviously you get to take some chips off the table at closing, protect that nest egg and invest it, but you also have the equity component. And on the equity component, it's going to be, let's call it 20 to 40% of the value of your practice retained in joint venture equity or rolled into holding company equity. We typically see the return within a 2 to 4 year window of 2 to 3x, possibly higher if you partner with a smaller DSO that's earlier on in their development. That's a huge return. There's very few places where you can put your money where you actually have some involvement in the company and in the business on a daily basis where you can generate that kind of arbitrage. So a lot of the reason for selling to a DSO is economic. And then a lot of it is driven by, wanting help from a management burden and improving that work-life balance. And then we've got obviously some older doctors that are closer to the tail end of their career that are using it as an eventual exit strategy. All right, what are DSOs looking for? The consolidation is happening across general dentistry and all dental specialties. So if you're in the dental industry, you own a dental-related practice, whether it's general dentistry, whether it's ortho, OMS, perio, an implant, cosmetic-focused practice, there is a lid for every pot in today's environment. Typically multiple buyers that would be interested in any type of practice. I would argue that implant-based practices, OMS, and ortho are probably the hottest verticals. That's where we see the highest demand and the highest valuations at the moment. But that comes and goes. The market fluctuates in that regard. Most DSOs prefer to buy practices located within 60 miles of a major metro area. Now, that doesn't mean if you're located in a tertiary market, there's not going to be demand for your practice. The difference is there might be less demand, possibly no difference in valuation. So same practice located in a major metro area may garner 7, 10, 15 offers. That same practice in a tertiary market, more rural environment, might only garner 3 or 4 offers. But there's still really heavy demand for DSOs as long as it's a quality practice with significant EBITDA, regardless of geography. TTM, that's a term that's thrown around a lot. That means trailing 12 months revenue. DSOs are really, really conscious of, they look at trends, but trailing 12 months, what have you collected? What was your EBITDA in the 12 months leading up to you going to market? And it's really hard to generate significant EBITDA if you've got revenue of less than 1.5 million. So if you're operating at a 20 to 25% EBITDA margin, and that's typically the goal, if you've got 1.5 million in EBITDA, 1.5 million in revenue, you've likely got around $300,000 in EBITDA. And that's kind of the starting point where we see the most demand. Is it possible to sell a practice if you've got EBITDA, of 200 to 300,000? Yeah, it's possible. But the most demand is for practices with EBITDA of 300,000 plus, and then demand ratchets up as the practice gets larger. The sweet spot right now seems to be somewhere in the range of $500,000 in EBITDA to $1.2 million in EBITDA. That's where we see the most interest in today's marketplace. Minimum of 5 ops. DSOs try to minimize key man risk. And the way to minimize key man risk is to have multiple providers at each office. You really need 5 or more operatories to have 2 or more dentists working out of that practice. And that's the goal of DSOs, to eventually have at least 2 providers at each office to bifurcate that key man risk between multiple providers. And a big one, the selling doctors and or associate doctors need to be willing to stay on for 3 to 5 years post-sale. So if you're looking to sell your practice and exit tomorrow, it's going to be really tough to pull off a DSO transaction unless the practice is truly absentee owner associate driven. But here's the key, and this is one of the things that has changed over the past few years. So DSOs used to require the selling doctor had to continue working chairside pretty much full time for at least 3 years post-close. Most DSOs now require a 5-year post-closing agreement. They want the selling doctor to stay on for 5 years post-sale in order to maximize value, but they actually don't care who works chairside. So a lot of our clients are selling under the narrative that they're going to continue working chairside for 2, maybe 3 years post-sale, and then step away from the chair and simply help the DSO manage the business and make sure the business doesn't move backwards. So DSOs really just want to know that the founder, the seller, has an ongoing interest in the continued performance of the business. You don't necessarily have to continue working chairside. That's been a major change. So we've seen an uptick in the post-closing commitment requirement to 5 years in order to maximize value, but that comes along with the freedom that you don't actually have to work chairside as long as you backfill your production with an associate. DSO practice valuations. So just to give you some insight into where valuations are currently sitting. A healthy EBITDA margin for a privately owned practice with revenue of 1.5 million or greater, somewhere in the range of 20 to 25%. Obviously, we see EBITDA margins lower than that, as well as significantly higher than that. Practices with EBITDA of less than $1 million typically sell in the range of 6 to 8 times EBITDA, while practices with EBITDA of $1 million plus typically sell in the range of 7 to 10 times EBITDA. So what factors impact the EBITDA multiple? And I'll touch on this a couple of times from this point forward. Everybody seems to be caught up on the EBITDA multiple. They want to pound their chest and say, I got 7 times EBITDA for my practice. I got 8 times EBITDA. I got 9 times EBITDA. The multiple matters, but you know what matters a lot more than the multiple? The EBITDA itself. Controlling the narrative regarding EBITDA is critically important in these transactions. And DSOs are well known for manipulating EBITDA. So they'll give you an 8 times multiple on an artificially low EBITDA number, and you think you got a great deal, when in reality, their multiple was actually 6 times your real EBITDA number had we done a valuation and controlled the narrative regarding EBITDA. So DSOs, private equity, tend to play games with EBITDA. It should be completely objective, but unfortunately, it's very subjective. So a big part of what we do is making sure we represent your EBITDA as high as it can possibly be. Do the homework on the add backs, the personal, discretionary, non-recurring expenses, and make sure that that EBITDA is defensible as we move into offers, negotiating a letter of intent, and then defending that EBITDA during the diligence and quality of earnings process. So controlling the narrative regarding EBITDA, the EBITDA itself is far more important than the multiple that you achieve. But let's look at what impacts the EBITDA multiple. So the EBITDA level, you can see those 2 bullet points above. I bifurcated EBITDA by, under $1 million, over $1 million. So the higher the EBITDA level, typically the higher the multiple. The number of doctors, more doctors, less key man risk. Number of locations. Although there is a misnomer, and we'll talk about this in a minute when we talk about debunking DSO myths, that more locations equal a higher valuation. More locations might equal a slightly higher multiple, but more locations come along with more fixed overhead. So typically, if you've got a $5 million single site practice with $1 million in EBITDA, that's going to trade for a higher valuation than a $5 million revenue practice that only has EBITDA of $750,000 because it's got more fixed overhead It's got lower EBITDA. Even if it fetches a slightly higher multiple, it's still not going to be able to catch the higher EBITDA single site practice. Geography matters to some degree. We talked about rural versus urban practices earlier. Infrastructure. Are you a scalable platform? Do you have centralized infrastructure, or are you a single practice? That's going to impact how private equity, how DSOs view you. Payer mix, fee for service, PPO, Medicaid, capitation. Most DSOs like to stay away from Medicaid unless they're PEDO. PEDO understands that there's going to be a Medicaid component. There are a handful of DSOs out there that do very well with Medicaid and actually gravitate towards Medicaid practices. But if you've got significant Medicaid exposure, it's going to limit your optionality. Service mix. Is it a bread and butter practice, or are you doing all on fours, veneers, heavy cosmetic component? In an economic recession, or if the key provider that has the super dentist that has the robust skill set steps out of the practice, those type of practices that are cosmetic focused typically take the biggest hit. So there's a little bit more risk in a heavy cosmetic practice than a bread and butter practice. Upside potential. What's the growth potential of the practice? Can you expand the facility? Can you expand hours? Are you marketing? Can you expand the service mix? Those things move the needle to some degree on the multiple. Ideally, especially in the environment that we're in today, where there's a focus on same-store sales growth, DSOs want to buy practices and will pay up for practices that have significant growth potential. What are the doctor's post-closing plans? In addition to controlling the narrative regarding EBITDA, controlling the narrative regarding your post-closing plans is key, right? Why are you selling? What are you looking to accomplish in a DSO affiliation? How much longer are you willing and able to work chairside? Once you step away from the chair, are you willing to continue to be involved in the practice from an operational management perspective to some degree? And then the owner's personality. This is what we tell all our clients. Be the most charismatic version of yourself and let us worry about the economics. Get to know the people. As we go to market and you get to meet all these DSOs, you get to interact with their team, with the doctors under their umbrella, the more they like you, it will impact the economics. Let us negotiate, let's play good cop, bad cop, right? You be good cop, I'll be bad cop. Let me negotiate, let me handle the economics. You focus on ensuring that the DSO falls in love with you. I think I saw a question come through. Yep, here we go. What if only associates do the dentistry and you're unsure if they would stay after the sale? This is a fantastic question. So we get involved with a lot of large multi-doctor practices where there have been discussions about an associate buying the practice at some point in time. Some of those discussions were just casual conversations, while others were much more formal. The DSOs care about the continuity of care, doctors, and productivity. So if you've got a major producer in your practice or more than one, the DSO is likely going to want to meet them and ensure that they're willing to stay on post-sale in order to buy your practice. So we run into the scenario sometimes where we've got a practice with a majority partner. Let's say it's an 80% owner, and there's minority owners, whether it's two associates that each own 10% or one associate that owns 20%. And I'm talking to the 80% owner. They're not really involving the minority owners in the conversation. And they're like, look, I've got a unilateral legal right to sell the business regardless if my associates want to come along for the ride or not. And this is the route that I want to go. We'll tell them at the appropriate time. Well, yes, you might have a unilateral legal right to sell the business because your minority owners can't stop you from doing it. But if they are major producers in the practice and DSOs care about key man risk and the continuity of productivity and not rocking the boat, they can stand in the way of you getting your deal done. So in some instances, what we've seen is DSOs or the practice owner will give the associates equity, whether that's equity in the practice at the joint venture level or holding company equity. So in other words, they allow them to share in the transaction, regardless if they have equity of the business or not, or they give them some type of retention bonus. If you agree to sign an employment agreement and you stay on for 2 years post sale, I'll give you $250,000. So there are ways that you can incentivize associates to play ball. But I would not encourage you to go into it with a blind eye thinking that DSOs don't care about associate retention, or if your minority owners are willing to play ball and go along with the sale. So anytime we get involved in a conversation with a practice owner that has high producing associates or minority owners, that's one of the first things that we're going to go through is, are the associate doctors aware? Do you expect them to stay on? When's the appropriate time to tell them and bring them into the fold? And then is there a way to incentivize them to ensure that they stay? All right. DSO deal structures. I could do an entire webinar solely on DSO deal structures, and I likely will in the coming months, and we'll make sure that we invite you back to listen to that webinar as well. There are all types of DSOs out there, and each one has a slightly different deal structure. But here I'm going to talk about the primary deal structures. So the old school DSO model, and it's still being utilized by some DSOs today, is the first bullet point there, 100% sale with a holdback. So I'm the DSO, I want to buy 100% of your practice. I'm going to give you, let's say, 70% cash at close, and the remaining 30%, I'm going to pay to you in annual installments, 10% per year, predicated upon you fulfilling a 3-year employment agreement and the revenue of the practice, maintaining what it was doing at the time I bought it. So that's kind of the traditional DSO model. We actually don't see that model being utilized very often in today's environment. There are a couple of kind of mainstay large DSOs that continue to use this model. And, if the doctor's selling for an exit strategy and has a finite, exit retirement date and doesn't really value the equity component, maybe we put some of those buyers at the table. But it's relatively rare that we use the 100% sale with holdback structure in today's environment. A lot of our doctors are younger. And, our average client age used to be, I'd say, 60, 65. Our average client age today is probably 45 to 50. And most of those doctors want that equity component. They want to enjoy the arbitrage that private equity is going to generate by buying their practice and building a sustainable company. So the next 3 bullet points are what we see most often. It's 100% sale with a holding company investment. So we call this the holding company model. That's where you sell 100% of your practice. You're going to take anywhere from, let's say, 70 to 80% cash at closing. And the other 20 to 30% of your practice value, you're going to invest in stock in the holding company. Where you enter the recap cycle, remember it's typically a 3 to 5 year recap cycle, will determine what your return is. So if you're entering very early in the recap cycle where you're going to buy that stock and you've got to wait, let's say, for 4 years to liquidate that stock, you would expect a higher return than somebody that is buying that stock a year before a recapitalization event. So as a result, this purchase price of the stock in the holding company is marked up throughout the life cycle of the recap. So that if you're joining right before a recapitalization event, your return is going to be muted comparative to the doctors that have been holding that stock for a few years. So that's a holding company model. Lots of questions to be asked regarding, where are you at in your recap cycle, right? When was your last recap? When's your next recap expected to occur? What's the projected return from this date forward on that recap? What am I paying for the stock? And show me the history of the growth of the company and how that stock has been marked up. A lot of questions to be asked there, right? And then how much can I liquidate at recap? Can I liquidate all of my holding company stock or only a part of it? Typically speaking, With holding company stock, you're allowed to liquidate all of it at a recapitalization event. So that's attractive to some sellers, and it's also attractive if you're entering very early in the recap cycle, especially with a smaller DSO that you really believe in, because the arbitrage is going to be significantly higher than if you enter late in the recap cycle or partner with a larger DSO. So that brings me to the joint venture model. The joint venture model is where you're actually retaining equity at the practice level. So I'm going to sell, let's say, 60% of my practice to a DSO, take 60% cash at close, and I'm going to retain 40% joint venture equity within my own four walls. The great thing about this model is typically you're going to get your pro rata share of ongoing EBITDA post-affiliation. So if I still own 40% of the practice, I'm still getting 40% of the EBITDA less the management fee that's being charged by the DSO. So in a holding company model, you no longer have equity at the practice level. You're no longer going to enjoy the EBITDA that's generated by your individual practice. Your bet in that model, your income outside of your chair side productivity, is all on the back end when that holding company equity sells. Versus the joint venture model, you've got your chair side income based upon your individual productivity, along with your pro rata EBITDA distributions along the way. And then at a recapitalization event, you're typically able to liquidate that equity in part. In most joint venture models, you're allowed to sell up to 50% of your retained equity at recap at the parent company multiple. So simple math, if you sell your practice today for 6 times EBITDA and you retain a 40% joint venture interest at recap, you're going to get to sell half, 20% of the practice for an exponentially higher number. If you sold at 6 times EBITDA and the DSO trades for 12 times EBITDA, you essentially doubled the value of that equity. So by nature of joining a larger entity overnight, you're going to double to triple the value of any joint venture equity that you still retain. But there's some questions to be asked here, right? We've seen some joint venture buyers not allow for ongoing pro rata EBITDA distributions. Well, that's the loss of a huge benefit associated with the JV model. We've seen some DSO buyers cap the multiple at which you get to sell your joint venture equity at recap. So in other words, they cap your multiple at 10 times EBITDA, but the DSO trades for 13 times EBITDA. You know, there was some arbitrage there that you lost and that the private equity firm took. So you want to watch out for caps on the exit multiple. You want to make sure that you're going to get your joint venture, distributions if they're not paying, a massive premium for the practice on the front end. And then understanding, how much equity you can sell at recap and then how your remaining equity can be liquidated, right? So in a lot of models with the joint venture component, they always want to have a vested doctor partner at the local level, meaning that through recaps, you can sell down your equity to a certain point. It might be 10%, might be 15%. And then when it's time to liquidate that remaining joint venture equity, it actually has to be sold to another doctor. So in a joint venture model, the remaining joint venture equity that you have left at the end of the day, it's going to be dependent upon you selling it to another doctor at more of a doctor-to-doctor valuation. Whereas in the holding company model, the equity is a little bit more liquid. You're typically able to exit it in full at the full arbitrage at a recap event. Moving on, we've got the hybrid model. The hybrid model is essentially a combination of the holding company model and the joint venture model, where they bifurcate the equity component into 50% joint venture, 50% holding company. So in this scenario, you might sell, let's say you're going to take 70% cash at close. The remaining 30% is going to be bifurcated 15% in a joint venture equity, retained equity at the practice level, then 15% in holding company equity at the DSO level. You're going to continue to enjoy those pro rata EBITDA distributions on the joint venture component, And then you've got the holding company equity that's diversified within the entire DSO that you can liquidate in full at a recapitalization event. So a hybrid model is just essentially a combination of the holding company model and the joint venture model. The last thing I'm going to touch on is the roll-up concept. So there are a lot of people out there today pitching the concept that you can take a bunch of unaffiliated practices, package them together, what we'll call like a duct tape DSO, loosely affiliate them. And while those practices individually might be worth 6, 7 times EBITDA, as a group, all going to market simultaneously and selling to the same buyer, they're worth 10 times EBITDA or 12 times EBITDA. That's snake oil, in my opinion. Okay. Anybody that's out there trying to sell the roll-up concept at a grand scale is doing it at their own benefit. Can you take a few practices in the same geography that are very similar, where the doctors all have a similar why, and sell them simultaneously to the same buyer for a slightly higher EBITDA multiple? It's possible. We've done it. But it comes at a cost, right? It comes at the cost of optionality, in the sense that it's very hard, for 3, 4, 5 doctors to all have the same why. And oftentimes those doctors, if they were to go to market on their own, would have all sold to different buyers for one reason or the other, whether that's fit, deal structure, valuation, whatever it may be, autonomy, support. So I don't love the roll-up concept. We've done it on a small scale, but today I'm seeing people out there pitching, join my co-op, join my DSO, and you're going to pay me $20,000 to $50,000 to join the DSO. I'm going to charge you monthly administrative fees for consulting. And then if and when this unicorn deal comes walking in the door and you all sell your practice simultaneously to the same buyer, I'm going to take a huge transaction fee, typically in the range of 10 to 20%. Those models are set up to do one thing and one thing only: line the pockets of the proprietor, the person that set it up. You are not going to win in that model. And unfortunately, we've seen a lot of dentists fall for these gimmicks, and they're getting ripped off. And it's our job, again, to educate and empower you to make a good decision with your practice. My advice: stay away from those roll-up models. Stay away from people that are pitching these unicorn deals, these, outlandish concepts. And if anybody promises you 10 to 12 times EBITDA for your practice that's got EBITDA of 500,000 or less, they're lying to you, bottom line. So very protective of this industry. It's what's put food on my table for over 20 years. And I want to make sure that nobody on this call tonight gets taken advantage of. And that's what we're really here to do, is provide objective guidance, make sure that you make a good decision with your practice. So the first 4 models, absolutely, well-tested, normal DSO deal structures. The roll-up concept, absolute snake oil in my humble opinion. So we've got a couple of questions that came in. Which model are most deals currently? So what is the deal structure that most DSOs are currently using? And the most common that we see are the holding company model and the joint venture model. So the holding company model is actually like a classic private equity model. In most industries, that's the model that's being used by private equity. But because in the dental industry, the performance of practices is so provider dependent, a lot of DSOs have started to gravitate towards the joint venture model or the hybrid model. They want vested doctor partners at the local level. So we've seen kind of a transition, from the traditional 100% sale with holdback model and the holding company model to more of a joint venture or hybrid model. And a lot of that's also being predicated by the fact that our sellers are getting younger. And the longer your runway, typically younger doctors like to have the joint venture equity. They want to continue to share in the ongoing EBITDA of the business and not give that all up immediately upon affiliating with the DSO. So I think the fact that we've got a younger seller base, and then we've got private equity that's getting smarter and understands how dependent practices are on having a vested doctor partner at the local level that's pushed, deal structure towards that joint venture and hybrid model. All right, so here was the title of the webinar, the 5 pillars of a successful DSO transaction. So we'll run through these and some nuances of each. Fit. Notice that valuation economics is not the very first, point. Look, economics matter to all of our clients. Valuation matters to all of our clients. It goes without saying that the goal here is to maximize the economic outcome. But you should also be focused on fit, deal structure, autonomy, and support. So we're going to go through each of these pillars and just talk a little bit about them. So fit. Anytime I'm talking to somebody that's considering going down the DSO path, the first question I ask is, what is your why, right? What are you looking to accomplish? Or is it solely economic? Is it an exit strategy? Are you planning on retiring or relocating at some point in time? Are you looking to de-risk? Are you looking for administrative support? You want to alleviate the burden of management? You want better work-life balance? And that's going to depend on whatever your why is, who you sell to, right? Because some DSOs offer a ton of autonomy. They have great infrastructure, but they may not be as aggressive on valuation and economics. There may be some DSOs that are vice versa, that have very little infrastructure. They're going to be very aggressive from a valuation perspective, but they're not really going to, be in a position to support you and alleviate that management burden. So you've got to evaluate what your why is, and that's going to dictate likely who you sell to and your post-closing happiness, right? And that's where we spend a lot of time getting to know our clients and making sure that we put you in front of a subset of the DSO marketplace that's positioned to help you accomplish your why and solve for the reason that you're going down the DSO path in the first place. I say this all the time. If you've met one DSO, you've met one DSO. They are all different. From a cultural perspective, they all have a different history. They offer different levels of autonomy. They offer different levels of support and infrastructure. They have, their management team has a different level of experience, a different pedigree. They all have different deal structures, and they all have different financial partners. So you want to make sure that, one, you define your why, and then that you evaluate, you create optionality and evaluate, what are the nuances between each of the DSOs at the table, and begin to look at, economics aside, who's the best fit. Once we get through the process of marketing a practice and we introduce a client to, let's say, 10 DSOs, and we have introductory Zoom calls or dinners or however you get to know the buyers that are at the table. Once all the offers come in, typically we say, all right, let's put the offers aside, economics aside. Who do you think's the best fit? Like, who are the top 2 or 3 buyers that you feel the best about? And let's figure out if we can leverage that competitive environment and negotiate the best economics possible with the buyer that you like the most. At the end of the day, we want you to maximize economics, but also end up with the best fit and the best deal structure we can possibly find. So now moving on to valuation. Critically important here. You have to create a competitive environment. If you respond to a piece of mail or a buddy that sold to a DSO referring you to the DSO that they sold to, if you don't have somebody like us at the table, if you don't create optionality, if you don't create a competitive environment, if you don't obtain multiple bids, you are going to leave a tremendous amount of optionality and economics on the table, to the tune sometimes of millions of dollars. And we're going to go into a case study here in a minute that explains exactly what I'm talking about. But you've got to create optionality. You've got to create competition. You've got to create the leverage you need to negotiate. And if you only have one buyer at the table or 2 buyers at the table, that's typically not enough to negotiate a more favorable economic outcome. As a result of hiring us, our clients on average achieve a valuation that's 20 to 25% higher than they would get by talking to that same DSO on their own. How do we know that? We're going to go through a case study in a minute that shows you exactly what we were able to accomplish for a client that already had an offer from a DSO. We walk in the door and immediately that DSO raises their offer by millions of dollars. So who you have on your team, how you market your practice, how you navigate this process, how you control the narrative regarding EBITDA is going to have a massive impact on the economic outcome of the transaction. Deal structure. How much cash versus equity are you getting, right? How sensitive are you to that? Some of our clients are really risk averse and they want as much cash at close as possible, while others, are less risk averse and they like the equity upside. They like the arbitrage opportunity of having holding company equity or joint venture equity. But you need to understand the different types of equity involved in these transactions and how that equity functions, right? When can you sell it? Are there any stipulations regarding what the value of that equity is at exit? How much of that equity can you sell at recap? Are you going to get your pro rata EBITDA distributions along the way, or is it all holding company equity? You got to ask the question about where is each DSO at in the recap cycle? What's your hold time to a liquidity event? And then what is the projected return at that liquidity event? So deal structure and fit, in my opinion, matter every bit as much or more than valuation. Autonomy. So a lot of our clients are terrified about the loss of autonomy. And that goes for clinical autonomy and operational autonomy. The good news is all the DSOs that we work with, and we work with about 50 regularly of the 300 that are out there, because those are the 50 that we've vetted, we've done business with, they're all going to allow for pure clinical autonomy. So they're not going to impact really what you do in the operatory. They're going to make sure that you use the labs you want to use the supplies you want to use. There's not going to be any quotas from a production clinical standpoint. That stuff doesn't really exist in today's version of DSOs, those DSOs that acquire practices. Now, look, it may still exist in the doc in the box, branded, de novo style DSOs of the world. That is a different world than the DSO environment that we operate in, where DSOs don't, rebrand your practice, and they don't buy practices. They don't start practices from scratch. They buy well-run practices from great doctors, treat them like partners, and allow them to keep their autonomy. Operational autonomy is important to a lot of our doctors as well. Are they going to be able to make the best decisions for their practice on a day-to-day basis with the help of the DSO's infrastructure supporting them? So, if they want to hire a new associate, can they hire who they want to hire? They want to hire a new staff member. Can they hire who they want to hire? How is the DSO going to be involved in that process? And most of the DSOs that we work with, they allow for a lot of operational autonomy. It's more of an a la carte approach. Hey, we have the infrastructure. You tell us what you want to help with, and we'll help support you. But if you don't need help, we'll stay out of your way. So from an operational perspective, from a clinical perspective, you're really not going to feel a major difference pre-affiliation to post-affiliation unless you want to. Now, occasionally we have doctors that say, I don't want to manage this business anymore. Find me a DSO that's got robust infrastructure and a strong hand from a management perspective, because I just want to be a doctor. I've got 3 years to retirement. I just want to be a dentist. I just want to focus on patient care, have somebody else run the business. Okay, well, that's going to be a really particular subset of the DSO marketplace. Well, we have other doctors that say, hey, this is economic for me. I want to take some chips off the table. I want somebody to give me a significant amount of cash, allow me that upside in the equity component, but leave me alone clinically and operationally. And that's another subset of the marketplace. And then a lot of DSOs kind of fall in between. But you got to be asking questions throughout the process of vetting the buyers at the table. What are you going to change post-affiliation, right? Can I keep my team? What is their pay and benefits going to look like? What is the patient mix, the payer mix going to look like? Operating hours. Are you going to rebrand my practice? Practice management software, is it going to change? You've got to ask all these questions as you go through the process so that you know what to expect post affiliation. And this is where, if you don't create optionality, you could end up not only leaving a lot of economics on the table, but you could end up with the wrong DSO or without the level of autonomy that you're looking to achieve. So far we've talked about fit, we've talked about valuation, we've talked about deal structure, we've talked about autonomy. And then support and infrastructure. How robust is the DSO's infrastructure? Are they prepared to help you accomplish your why? If you're selling because you want to alleviate the managerial burden and you want administrative support, well, the DSO better have the infrastructure to help you from an operational perspective on the day-to-day. If they don't have any infrastructure and they're kind of hands off, then maybe that's not the right DSO for you if your why was to alleviate the management burden. So making sure that your why aligns with the amount of support and infrastructure that the DSO is able to provide is critical. So moving on, let's talk about debunking DSO myths. We've got probably about 15, 20 minutes left of the webinar. So again, if you've got questions, I encourage you to type it in the bottom right-hand corner or shoot me a text. So debunking DSO myths. We already talked about the fact that DSOs kind of used to be a 4-letter word. DSOs are evil. I think that's been demythed over the past 5 years as more and more doctors have gone down the DSO path and been happy and been successful and reach recapitalization events. The moniker of DSO kind of being a 4-letter word has started to fade away. But there are bad DSOs out there, right? There's over 300 DSOs. We only work with about 50 that we vetted and that we trust. And if you don't create optionality, if you don't do your homework, if you don't ask the right questions, if you don't have strong representation, you could end up selling to the wrong DSO, selling to a bad DSO, or selling your practice when maybe it wasn't the right time or a DSO affiliation wasn't the right fit for what you were looking to accomplish. All DSOs are the same. I already said this earlier. If you've met one DSO, you've met one DSO. We talked about the 5 pillars of a successful DSO transaction and the fact that a lot of people believe economics, valuation is more important than fit or deal structure. I would argue all day that fit and deal structure are more important than valuation. Everyone focuses on the EBITDA multiple. So we talked about that before, how critical it is to control the narrative regarding EBITDA. Everybody wants to brag about, I got 8 times EBITDA, I got 9 times EBITDA. 9 times what? 8 times what? Every dollar of EBITDA is worth $7 and $9 in value. So controlling that narrative regarding EBITDA and making sure that you've got proper representation and you're controlling that narrative and not allowing the DSO to tell you what your EBITDA is critically important to maximizing the economic outcome. We talked about the fact that a lot of people think more locations equals a higher valuation. More locations equals more fixed overhead and erodes EBITDA. Therefore, ideally, you've got high production, high revenue at all of your locations, and you're operating at an EBITDA margin of 20% plus. Private equity buyers pay more for practices than DSO buyers. I hear that a lot. I want to sell to private equity because I want a higher multiple rather. So in other words, I want to sell directly to private equity as a platform investment because they pay higher multiples than DSOs do. That's true. Private equity does typically pay higher multiples for platforms than a DSO will pay for a platform. But they're going to insert costs associated with the centralized infrastructure that's necessary to make that platform fully scalable. So a private equity firm would typically bid a higher multiple on a lower EBITDA number, while a DSO will strip out any centralized infrastructure or not have to build it because they already have it. They'll pay a lower multiple on a higher EBITDA figure. So we often see that when we take an opportunity to market and market it to both private equity buyers and DSO buyers, and those are different things, right? Private equity firms that are looking to enter the dental market versus a DSO that has already built infrastructure and is private equity backed. We'll market it to both of those types of buyers, and the valuations are often very congruent with each other because they're both bidding off a different EBITDA number predicated upon, what infrastructure they currently have or need to build. And this is a really common one. I'm already in discussions with a DSO, therefore I don't need a broker. So we don't refer to ourselves as brokers. We refer to ourselves as sell-side advisors because we do a lot more than find a buyer. I would say the vast majority of our clients are already talking to a DSO or have an offer on the table at the time they engage us. You absolutely need to have representation. You absolutely need to create a competitive environment for your practice if you want to find the right fit and you want to maximize your economics. So just because you're already talking to a DSO does not mean that you don't need somebody like us to represent you. And in that scenario where you're already in a discussion, maybe you already have an offer, we typically say, hey, hit timeout, okay? Tell them you're going to take a step back, that you're going to hire an advisor, you're going to get an objective EBITDA analysis and valuation, and when the time's appropriate, you'll give them a call and you'll re-engage in that conversation. They're not going anywhere, okay? They're going to be disappointed because they want to do a deal in the dark. They would prefer that you're not represented because they know they're going to buy the practice for a much lower valuation. And if you're introduced to somebody like us, it's going to increase the price and it's going to increase the optionality. Therefore, it lessens their ability to win that deal without interference or paying more. So we just say, hey, hit timeout. Let's take a step back. Let's do an EBITDA analysis. Let's do a valuation. And then let's package the practice. Let's control the narrative and take it back to market, including put it in front of the DSOs that are already at the table. And the economic outcome, no doubt, will significantly improve comparative to the conversations that you've had up to that point. I think I saw a question come in. All right, here's a question. How do DSOs prefer to deal with real estate? Do they lease? Do they purchase? What do they generally prefer to do? So most private equity DSOs would prefer to lease the real estate. They want to keep as much as their dry powder available to invest in practices and growing the EBITDA rather than building a real estate portfolio. Most of our clients want to retain the real estate. And the reality is that if you sell your practice to a private equity-backed DSO, you've now got a very well-capitalized long-term tenant. So you could go sell your real estate at any point in time to an investor for a premium compared to likely what it's worth today. If you did want to sell your practice simultaneously with your real estate, there are some DSOs that will buy real estate and your practice. There are a lot of them that will actually partner with a REIT that was designed to acquire dental occupied real estate alongside a DSO. So there's a lot of optionality in that regard. If you want to sell your real estate in conjunction with your practice, you absolutely can. If you want to retain your real estate and lease it to the DSO, that's the most common way to treat your real estate in a DSO affiliation. So I'm going to talk a little bit about our process, and I'm going to show you a few case studies, and then we'll wrap for the evening. So this is our proven DSO affiliation process. It always starts with a confidential discovery call. Let's just chat, right? Let's get to know each other. Let's build trust. Let's talk a little bit about your why, talk a little bit about your practice, and see if it makes sense to move on to the next step of the process and do a detailed EBITDA analysis, evaluation, a deep dive on your practice. Look, regardless if you're thinking about selling tomorrow or 3 years from now, I encourage you to go ahead and have us do an EBITDA analysis, have us do evaluation now to quantify what is your EBITDA, what is your practice worth today, and if you're not ready to go to market, then let's chart a course to get you where you want to be economically. And we'll update the valuation at no cost in the future when you are ready to go to market. But once we've done that deep dive, it allows us to be a much more impactful advisor to you, because if we're just speaking in generalities, everything I say is anecdotal, right? Like this webinar, everything I'm saying tonight is anecdotal in nature as it applies to your specific situation and practice. Once we've done the deep dive, once we've done the analysis and the valuation, you can call us anytime at that point moving forward and say, hey, I'm thinking about dropping this PPO plan or buying a second office or starting a third office or what have you. And we can coach you on how is that going to impact marketability and value at the time that you go to sell. So once we get to the analysis and evaluation, we review it, we discuss options. If it makes sense to pursue a DSO affiliation, now's the right time. We'll sign a listing agreement and take the practice to market utilizing a bid process. So this is one of the other keys to maximizing economics in these transactions. The valuation is a private conversation between the veil between you and us. You're our client. We represent you and only you. We don't represent buyers. So that valuation is a private conversation designed to set a baseline expectation on the value that we believe we can achieve in the open market. And at the point that we get through that and we agree on expectations and it's time to go to market, we put the practice out in a bid process. It's very situational regarding what from DSO to DSO they will bid on a particular opportunity. And we want to make sure that we don't leave any money on the table. So we found that the way to ensure that we maximize value for our clients is to put it out in a bid process, because especially with the larger practice, you can see the bids range, by millions of dollars. So we recently marketed a practice with about $1 million in EBITDA, and the bids, the delta between the lowest bid and the highest bid was about $4 million. So that's a massive range. Had we priced the practice, we likely would have left some money on the table when you're talking about those top tier bids. We create a highly competitive process among numerous buyers. So we're typically going to take each practice that we list to market and put it in front of anywhere from typically 7 to 15 buyers. The 7 to 15 buyers that out of the subset of the DSO marketplace that we work with on a regular basis, who do we feel that are the top 7 to 15 that are going to be aggressive on this particular opportunity and are well positioned to accomplish your why? We're going to help you interview and vet potential buyers. We're going to be there for those initial meetings and Zoom calls. We're going to give you a list of discussion topics and questions to ask. We believe that diligence is a two-way street. Yes, the DSO is going to ask a ton of questions about your finances and your operations. They're going to want to get to know you. You should be asking just as many questions about them and getting a feel for, again, that fit and deal structure and how is the equity component going to play out economically. We're going to obtain and compare multiple offers. We actually have a pretty sophisticated cash flow model that we run once all the offers come in to show you offer to offer how they play out economically, typically over a 5-year window, so that you can really compare apples to apples, considering the fact that all the deal structures are different, all the DSOs have a different form of equity. The equity functions differently at recap, and they're all at a different stage in their recap cycle. We've put together a comparative analysis to allow you to compare apples to apples and make a decision from an economic standpoint. We're going to determine which DSO is the right fit and negotiate the most favorable outcome we can with that particular buyer. And we quarterback the process from start to finish. We're your advisor, we're your advocate. We just want to make sure at the end of the day that you make a good decision with your practice. And should you decide to go down the DSO road, you get every penny that you deserve for your practice, and you partner with the right DSO, and life post-affiliation is as enjoyable or more enjoyable than it was pre-affiliation. So a couple of case studies. This transaction is actually closing on Friday. So this was a general dentistry practice in a major metro area in Georgia. Our client's 58 years old. They were selling to obtain administrative support and for exit planning purposes. They're closer to the tail end of their career than they are at the beginning of their career. Revenue of $3.6 million and EBITDA of $1.3 million. They already had an offer in hand from a DSO that they liked at $6.8 million. And they felt that was a good offer. We said, hey, why don't we hit timeout? Let's do an EBITDA analysis. Let's do evaluation. Let's objectively figure out what we think we could fetch if we took the practice to the open market. We did the valuation. It came in at $8.5 million. So about 1.7 million higher than the offer that the doctor had in hand. Honestly, they were a little reluctant to list with us. They were a little skeptical that we'd actually be able to achieve that level of a premium by going to the open market. Because they were already talking to a DSO, they were on an accelerated timeline, they wanted us to run a limited process. We only put this practice in front of 7 buyers. We received 5 offers, one of which was from the DSO that was already at the table. We ended up signing an LOI at 9.6 million, plus a substantial growth-related earnout. And our doctor chose to do a 75-25 holding company structure. He took 75% cash at close and rolled 25% into holding company in the DSO. So you can see offer, unsolicited offer, 6.8 million. Valuation we did 8.5 million. Practice ended up trading for 9.6 million plus a growth-related earnout. Guess who it sold to? It sold to the same DSO that had made the $6.8 million offer. So it sold for nearly $3 million higher, almost a 50% premium compared to the unsolicited offer, simply by that doctor calling a timeout, engaging us, and allowing us to take the practice to market, control the narrative, and create a competitive environment. So we're thrilled with the outcome that we got for this doctor. And obviously, he's super appreciative and thrilled as well. So moving on to case study number 2, we had a general dentistry practice in a major metro market in Florida. Doctor's 40, so young doc around my age. He's got a young family. He was selling to de-risk to take some chips off the table and obtain a partner that could help facilitate further growth. So he expects that his practice is going to likely double in size over the next few years, but he's got a young family. He's already a little worn out from an operational perspective. And with the growth rate of his practice, he wants to offload some of that managerial burden, partner with somebody that can help facilitate that growth, without him wanting to jump off a bridge. So revenue of 4.3 million, EBITDA of 1.2 million. So good EBITDA margin, a little over 25%. We did a valuation, came in just under 8 million. We received 9 offers, and he ended up signing an LOI at $10 million, 8.6 times EBITDA, plus a 4 million growth bonus, based upon hitting some very achievable post-closing growth targets. And he did a 70-30 joint venture structure. So he sold 70% of his practice. He retained 30% equity within his own 4 walls because he's younger, right? He's got a longer runway, and he wants to continue to enjoy his pro rata share of EBITDA on an ongoing basis, especially given that his practice is poised for rapid growth over the next few years. So again, blew away our valuation on the baseline value deal and got him, a substantial growth-related bonus. Case study number 3, I wanted to throw a specialty practice in here. So we had an OMS practice located in a major metro area. Doctor's 52, really selling mainly for economic reasons, but it was a multi-site practice. He needed to recruit a couple more doctors and wanted some help from an administrative standpoint to help continue to scale and grow the business. Revenue of 7.5 million, EBITDA of 2.3 million. We did a valuation of $18 million. He received 7 offers. Again, OMS, there's about 12 buyers in that space. 7 of them bid on this practice. We ultimately inked an LOI at 23 million, 10 times EBITDA, $5 million higher than our valuation. And I point that out to show you when we do a valuation, we're truly setting a baseline expectation. We hit or exceed our valuation every time. We're not like some other brokers that blow a lot of smoke and tell everybody they're going to get 10 times EBITDA for their practice. We're going to set a realistic goal, make sure that expectations are aligned, and then go to market and try to crush, that valuation. So he did an 80-20 holding company structure, which is actually really popular with specialty DSOs. They tend to use the holding company structure more frequently than, general dentistry DSOs. So 80% cash at close, 20% invested in the holding company of the DSO. I really appreciate you spending the last hour and a half with me. I hope you learned a lot about the DSO marketplace. The next step for us is to schedule a discovery call. Would love to speak with you, get to know you, learn about your situation, and help guide you down the path to making the best decision for the future of your practice. Whether that means not selling, whether that means selling to a DSO now or 3 to 5 years from now, would love the opportunity to meet you. And after the webinar ends, you're going to be prompted to go to a free consultation page. I encourage you to fill out that form. I'll follow up with you. You'll be speaking directly with me. And thanks for your time tonight. Take care. Bye-bye.